With the Federal Reserve pivoting back to the money printers, what is next for jobs and for your retirement account? Last week, James Lavish did an excellent thread on Fed pivots, laying out what they are and what they do. So first off, what is a pivot? A Federal Reserve pivot is when the Fed switches from making it more expensive to borrow money, called tightening, to making it cheaper, called easing. It does this by lowering interest rates, so making it cheaper to borrow, and by printing fresh money to buy stuff like bonds, called quantitative easing or QE. The goal of cheap money is to artificially boost the economy, but of course even the Fed knows that this causes inflation, which is why it is so odd to do it with inflation running so hot. Hence many assume it is a gift to Biden's very dim re-election prospects. Now, the past couple years, the Fed has kept money very tight, meaning high rates and actually selling off the assets they had bought and canceling the dollars. They did this to trim the inflation they had caused by making money super cheap during COVID. In fact, most of the time since around about 2008. So what happens in a Fed pivot? There's two main parts, the economy and stocks, your retirement account. For the economy, historically, pivots usually mean a recession is incoming. That's because the Fed knows everything it does destabilizes markets in the economy, so it generally tries not to change from tightening to easing too often. In fact, when it does, it's often called a policy error, as in they screwed up. So when they do flip, it usually means they've gone from being afraid of inflation to being afraid of recession. So they are suddenly making money cheap to try and plug the coming slowdown. Put differently, a pivot essentially predicts a recession, at least historically. Not immediately, of course. There's something called lag effects, meaning it takes time for the Fed to break things. But typically, the recession starts and unemployment soars within about 12 to 18 months. Note that unemployment typically doesn't actually jump until after the recession already started, so the stock market is usually a much better actual predictor of the recession. So how do pivots affect stock markets? As James put it, historically pivots have been, quote, downright ominous for equities. In the last 4 recessions, stocks fell an average of 1/3, so 32%, after a pivot. This again usually happens in about that 18-month time frame, although in 1987 it took more than 2 years, which culminated in the famous Black Monday crash when stocks fell 23% in a single day. So what's next? Brought to you by Unchained.com. I mentioned last week that pulling a pivot in the middle of the hottest inflation in a generation smells of either desperation or a level of political cronyism that would mark a new low for the Fed. Either way, the most likely scenario going by the last 50 years of business cycles is that we are headed into recession and stocks will take it on the chin on the way down. Of course, I could be wrong, especially on stocks. The old Wall Street joke says the market will do whatever embarrasses the largest number of people. But for me anyway, investing in stocks right now feels like picking up dimes in front of steamrollers. Okay, we'll be watching. See you next time.